Your savings account is not safe. It is quietly burning your money every single day through inflation, and the longer you play it safe, the more you guarantee a loss in real life, not just on paper. Imagine this. Natalie opens her banking app, smiles, and leans back in her chair. Nice, $15,000. Safe, growing. She taps into the savings tab, sees the tiny interest line, and feels that quiet pride most people never say out loud. At least I'm being responsible. But here's the twist. In the real world, that same responsible money is shrinking. Every grocery run, every rent increase, every medical bill quietly steals its power, while the number on her screen tricks her into feeling secure. I'm a Jazz, I have a master's in finance, and I've spent years studying how ordinary people try to be safe with their money and still end up broke in real terms. My goal with this video is simple: to show you why your savings account is silently making you poorer, what actually counts as safe money, and how to fix it without doing anything extreme or reckless. Let's start with the lie your bank balance is telling you. Your savings account number almost never goes down. It might be 10,000 today, 10,050 next month. That upward drift feels like progress, and your brain loves it because it sees green numbers and zero volatility. But when inflation is running at 3 to 4% a year and your safe savings account is paying 0.5% or 1%, what looks like growth is actually a slow leak. In real terms, you're losing 2 to 3% of your purchasing power every year while thinking you're doing the right thing. Here's the inflation erosion trap in simple language. If your bank pays you 0.5% APY and prices rise 3.5% per year, the gap is 3%. That gap is your real loss. So you might see your balance grow from $15,000 to $15,075 at the end of the year and think, nice, free money. But if the cost of food, rent, and everything else went up faster than that, your $15,075 actually buys less than your $15,000 did last year. You are not just standing still. You are moving backwards slowly enough that you don't feel it until it's too late. Let's bring in our composite character, Natalie. 10 years ago, she built up a solid $30,000 in a traditional savings account and decided, I'm not a risk taker. I'll just keep it safe here. Her bank paid her something like 0.5 to 1% a year on average. During that same decade, inflation floated around 2 to 4% most years, spiking higher in some. Over 10 years, that gap compounds. On the screen, Natalie's balance might have crawled to around $33,000 to $34,000. In the real world, though, that money lost roughly $8,000 of actual purchasing power. In today's dollars, it behaves more like $22,000 than the $30,000 she started with. Now compare her to James. James also had $30,000, but he did something different. He kept only about 3 months of expenses in a high-yield savings account paying around 4 to 4.5% APY, and he invested the rest into a broad total market index fund. That meant he had enough cash for emergencies, but he didn't let the rest rot in a low-yield account. Over the same 10-year period, his high-yield savings roughly kept pace with inflation, and his investments rode the long-term growth of the stock market. Result? After 10 years, James sits at around $52,000, while Natalie's money, adjusted for inflation, feels like about $22,000. Same starting point, very different outcome. Here's the uncomfortable question. Which one actually played it safe? On the surface, Natalie seems responsible. No market risk, no volatility, no scary red numbers. But by avoiding visible short-term risk, she locked in a near-guaranteed long-term loss. That's not safety. That's a slow, quiet wealth tax. James, on the other hand, took calculated, controlled risk with a portion of his money. He protected his short-term needs in safer cash and allowed his future self to benefit from compounding in the markets. This is where most people get trapped. We confuse no volatility with no risk. Your savings account looks steady, so you call it safe. The stock market bounces up and down, so you call it risky. Your brain hates seeing losses on a chart more than it hates invisible erosion from inflation. But think about this. Which is riskier, having your balance swing from $30,000 to $27,000 and then up to $35,000 over a few years, or keeping that $30,000 perfectly stable while prices move so far ahead that it behaves like $20,000 in real life? Let's peel back one more layer. Why are we so emotionally attached to cash? Most of us were taught, explicitly or implicitly, that saving is virtuous. Save for a rainy day. Cash is king. Don't lose money. And look, having cash is important. An emergency fund absolutely matters. But somewhere along the line, we turned a good concept, having some cash, into a blanket rule. More cash is always better. That's where the trap starts. A lot of middle-class money mistakes come from this mindset. Things like keeping way too much money in low-yield savings instead of investing, confusing a big cash balance with real financial security, ignoring inflation completely because, at least I'm not losing money. Financial advisors repeatedly warn that parking long-term money in regular savings is one of the worst habits because it quietly destroys your future options. Meanwhile, your bank is not complaining. They take your deposits, pay you 0.5 to 1%, then turn around and lend that money out at 4 to 7% or more in mortgages, personal loans, and credit cards. Their profit comes from the spread between what they pay you and what they earn. You feel safe. They make money off your fear of risk. You get the illusion of security. They get the actual yield. So if just keep everything in savings is a bad plan, what does a smart, safe strategy actually look like? This is where the tiered liquidity framework comes in. Think of your money in 3 layers: immediate, short-term, and long-term. Each layer has a job. Each layer has a place. Tier 1 is your checking account. About 2 weeks of expenses. This is the money that needs to be instantly available. Rent, groceries, bills, your day-to-day life. You don't chase yield here. You chase reliability and access. The job of Tier 1 is not growth. It's smooth daily operations. If your monthly essentials cost, say, $1,500, you might keep around $750 in checking as a baseline, replenished as income comes in. You don't park $10,000 here, just in case. That's excess cash doing nothing for you. Tier 2 is your high-yield savings account, roughly 3 months of expenses. This is your true emergency fund. Job loss, medical surprises, a big car repair. Stuff that would genuinely hurt if you didn't have cash ready. Here, you put the money in a high-yield savings or money market account paying a competitive APY, often 3 to 5% when rates are decent, so you at least blunt the impact of inflation. Still, this is not your wealth-building machine. It's a shock absorber. Once you've hit that 3-month buffer, maybe 6 months if your income is unstable, every extra dollar doesn't belong here. Tier 3 is your brokerage account. Everything else. This is where long-term money lives. Money you don't need for at least 5 to 10 years. This is where you own assets, broad stock index funds, ETFs, maybe bonds depending on your risk tolerance. Yes, this tier moves up and down. Some years it might drop 10 to 20%. Other years it might jump 15 to 25%. But over long periods, broad markets have historically grown faster than inflation, which is exactly what you need if you want your future self to be richer, not just older. Let's go back to Natalie and James with this framework in mind. Natalie essentially shoved everything into Tier 2 or even Tier 1. She had no real Tier 3. Her whole plan relied on the illusion that her bank balance equaled security. James, on the other hand, set his tiers: 2 weeks of expenses in checking, 3 months of expenses in a high-yield savings account. Everything above that automatically funneled into a diversified index fund through his brokerage. 10 years later, he didn't just have a nicer chart. He had options: flexibility to change jobs, cushion against inflation, and a real shot at financial independence. Here's the crazy part. Both of them thought they were being safe. Natalie defined safety as never lose a dollar on the screen. James defined safety as protect my short-term needs and let my long-term money outgrow inflation. One definition leads to quiet decay. The other leads to resilience. If you're watching this and thinking, okay, but I'm scared of investing, your feelings are valid and also expensive. Fear of investing is usually fear of short-term losses. But the price of avoiding those short-term drops is guaranteed long-term erosion. You are paying a hidden fee called missed growth. On a practical level, you don't have to become a stock picker. You don't need to predict markets, time recessions, or chase hot sectors. Broad, low-cost index funds exist precisely so regular people can own the market without making it a full-time job. You might also be thinking, but I can barely save at all. How does this apply to me? Here's the good news. The framework still works at smaller numbers. If you have 1,000 total, maybe 300 in checking, 700 in high-yield savings. No investing yet. At 5,000, 2 weeks of expenses in checking, 3 months in high-yield savings, and anything above that starts trickling into an index fund, maybe 50 or 100 per month. At 20,000 and beyond, the difference between parking it all in savings versus respecting the tiers becomes massive over a decade. The real shift you need is this: stop asking, how much cash makes me feel safe? And start asking, how much liquidity do I actually need? And how do I protect the rest from inflation? Safety is not the absence of movement. Safety is having the right kind of money in the right place for the right time frame. Checking for today. High-yield savings for real emergencies. Investments for the future you're actually going to live in. So what should you do after this video? First, log into your accounts and write down 3 numbers. How much is in checking right now? How much is in any savings accounts? How much is invested, if anything? Then ask, if I lost my job tomorrow, how many months of essential expenses could my savings cover? If the answer is under 1 month, your first mission is to build Tier 2, your emergency fund, while keeping checking lean. Once you hit about 3 months of expenses in high-yield savings, you have a new rule. Extra money no longer stays in savings. Tax refund? Slice off a bit for fun if you want, but then push the rest into investing. Bonus at work? Same thing. Side hustle income? Set an automatic transfer so it doesn't pile up in a 0.5% graveyard. And when you hear people brag about their big savings balances, understand what you're really hearing. Sometimes it's discipline and intentionality, but many times it's fear wearing a responsible mask. It sounds like, I don't trust myself, I don't trust the market, I don't trust the future. So I'll just sit in cash and hope nothing gets too bad. Hope is not a hedge against inflation. A framework is, your savings account has a role. It is not the villain. It's just been miscast as the hero. Use it for what it's good at: liquidity, stability, and emergencies. Stop using it as your main wealth strategy. That's like using an umbrella as your only housing solution. Fine for a storm, terrible for a decade. Let's push this idea one step deeper, because this is where people either stay stuck for years or finally break out. Most people think the big leap is savings account to investing, but the real leap is identity. Are you the kind of person who just stores money, or the kind of person who manages capital? When you see your savings as capital, you stop asking, how do I protect this pile? And start asking, how do I put this pile to work without blowing it up? That tiny mindset shift is what separates Natalie from James. Think about it this way. Every dollar you own has a job description. Some dollars are emergency firefighters. They live in your high-yield savings, waiting to put out financial fires. Some dollars are construction workers. They live in your investments, slowly building the future house you'll live in. The mistake is forcing all your dollars to sit in the lobby doing nothing, just in case. That's not safety, that's mismanagement. And you don't have to overhaul your life overnight. You can start with one small rule. Every time money hits your account, a fixed percentage automatically follows the tiered plan. A slice to checking for this month, a slice to high-yield savings until you hit your target, and a slice to your brokerage for the future. No drama, no overthinking, just a system that quietly turns you from a saver into a builder. So the next time you open your banking app and feel that little rush seeing a big savings number, pause and ask yourself, is this number making me feel safe or actually making me safe? Then make one tiny move that lines up with the second, not the first. If this opened your eyes to how much your safe money might be costing you, here's your next step. Don't just click away and forget. Open your banking app after this video, calculate your 3 tiers, and move one small amount, no matter how small, into the right place today. Future you will thank you for doing what present you is scared of. If you found this helpful, hit like so more people realize their savings account is quietly draining them. Subscribe for more no-nonsense money breakdowns, and tell me in the comments. Are you more like Natalie right now or more like James? And what's the very next move you're going to make?